Day today, and I'm going to tell you about that in a minute, but I really did promise you for JJ the CPA's Small Business Toolbox that I would tell you a number of things in the first 5 minutes. So I want to get after that, and then I'm going to tell you why we're having a very unusual day, that this really isn't how the show is going to be as we move forward, but nonetheless, I promised we'd go on live today at 4, so regardless of the two major things happening today, we are doing that. So the self-employed small business owner is the focus of my channel as we go forward. It's really always been the focus. And the topics I was going to hit right at the beginning start with this. What are the two most overlooked tax deductions when we're talking about small business owners and the self-employed? So I've been practicing now for 30 years, and I am in the trenches every day working with clients. And this is what I've come across. Number one, it is writing off your cell phone. The cell phone charges, especially with the self-employed, comes as a separate bill. If you have a separate bank account or a business, you should be paying that directly from that account. The second is the internet at your house. You are not able to write off your first phone line according to the IRS. You can write off a second or any additional phone lines if you have a business and you're using it for those purposes. But no matter what, you can write off the internet, and that is regardless if you take the home office deduction, which is always something that kind of tied to that overlooked on Schedule C, a simplified method that allows you to take a very easy deduction related to using your home for business. Now, why do you want to be an S Corp? Boy, that's a big question. The other thing I'm going to let you know is that each one of these topics I'm going through right now, I will put together a video dedicated to those to then give you some more details to that. But why would anybody become an S corporation? This would be somebody that is self-employed, filing a Schedule C, maybe a Schedule F. And it's to save self-employment taxes. See, when you file a Schedule C, no matter what the net income is, you're going to pay self-employment taxes on that, which is 15.3%. So if you just net $20,000 on your Schedule C, sole proprietorship, self-employed, you're going to pay over $3,000 in self-employment taxes. By becoming an S corporation, your net income, that same $20,000, goes in another area of the individual tax return, and that net income, there's no tax at the corporate level, and that net income is not subject to, by law, by statute, self-employment taxes. So you would take the same set of revenue and expenses, and on Schedule C it nets 20 grand versus on an S Corp netting 20 grand. There's a $3,000 tax difference in that simple example. You bet there's pros and cons, not too many. And that's where I'll go through that in detail. But why would anybody become an S Corp? That's the number one reason. How is an S Corp different from an LLC? This is actually pretty simple. An LLC is your legal designation. That is what you would set up at the Secretary of State in your state. The wonderful thing about the LLC, Limited Liability Company, is that it is a chameleon, which means that it can be taxed as anything. So it can be taxed as an S Corp. So there is no difference between an LLC and an S Corp because they're apples and oranges. An LLC makes an election on either Form 8832 or Form 2553, or by not making an election to either be a partnership, an S Corp, a C Corp, or a disregarded entity, which is a single member LLC reporting on Schedule C. You can report it on Schedule E. You can report it on Schedule F. You can have an LLC that doesn't own anything in the current moment, and it doesn't need to file anything. So when I say what is the difference between an S Corp and an LLC, the LLC is the legal designation. The S Corp is the tax designation. Now I'm really going to tell you in a simple way, and I'm going to be putting together a video in a little more length about this, but what's the difference between an IRA, a Roth IRA, a 401k, a simple plan, or a SEP, self-employment plan? Really the biggest is that from the Roth, you don't get a deduction going in, therefore it's not taxable when you pull it out. All the rest, they're the same in that they are tax deductible when it goes in, and then in retirement, you're going to pay tax when you pull it out. But see, that's how they're all the same. What's the difference between all of them? And it's actually pretty simple, because the only difference between each of them is how much can you actually put into them in any given year. Meaning, these are all what they call qualified plans. Qualified means you have to meet certain qualifications. 401k, if you're self-employed or have wages, well, you've met the first qualification. Same thing with the simple plan. Now with the SEP and the IRA, and when we're talking about the self-employment, if you have self-employment earnings, all of those are an option to you, but how much can you put in? That's another major difference. But what is the difference between all of them is simply this: how much can you put in? If you're not really looking at putting more than 1,000 in, any one of those, probably other than a Roth, is going to accomplish the same thing for you. So the key here is that you need to be looking at retirement without the excuse of, I don't know if I should do a SEP or a 401k or a simple plan. So look for the video that will be coming related to that. The other thing is, why should you have a separate bank account? So when I'm first talking to clients, here's the reason. You need to know what your business is doing. So a lot of clients will, over the years, give me the excuse of, well, I don't have my financials yet, I'm not sure where my numbers at. But by looking at a simple bank account, what is the inflow and the outflow, other than you borrowed money or you put money in yourself? If you have a separate business account, you can tell in a snapshot on a bank statement or scrolling through the app, what is your revenue? And same thing with the expenses. So the most simple reason is for that. Maybe you're not required because you're self-employed, but it sure makes great sense to separate that out. And lastly, how much life insurance does a business owner need? When we're talking strictly the business owner, as it relates to the business, it would be enough life insurance to cover the debt of the business if that owner were to pass away. Now, how much would it be, though, that somebody should have in life insurance as a business owner, but to take care of their family? Because you don't need life insurance on yourself. You need life insurance for, in essence, those you're going to leave it to. So it sounds like a opposite of things of what I just said to you. But yes, you need to have life insurance that is on you, but it is not for you. It is for those that are leaving behind. The reason I preface that is that it's really simple. It's a calculation. It's not an emotional decision. What do you live on in a month times 200? It's called the rule of 200. You can look it up. So if you live on $5,000 a month, take that times 200, that is $1 million. You need $1 million of life insurance to then take care of your family forever for it to generate $5,000 a month. How? Well, if you have $1 million in life insurance and unfortunately something happens to you and it pays out, $1 million multiplied by an average rate of return, 6%, would yield $60,000 a year or $5,000 a month. Now, another aspect is just real simple. What's your personal debt? That plus what you live on times 200, pretty simple on how much life insurance you need. Now, those of you that have been tuning in for a long time, you know that that was a good college try of fitting that in to 5 minutes. So with this being said, thank you for tuning in live. I wanted to let you know that this is not how the show will look. This is not how the show will be. But my producer, who is also the love of my life and my fiance, we were in the ER last night and she is doing okay. She had a kind of a minor major thing that happened, but she's home doing well. She is looped up on some pain medication. We expect a very quick recovery, nothing life-threatening, got past any and all of that. But nonetheless, we have where in the first 30 seconds, you're going to see graphics come up. She's created a little tiny video. We're going to have other things that'll pop up. And as I'm going through the subjects, you'll see some graphics that come up and it will feel much more like a show, something that we've been dreaming about for a long time. So I hope that you tune in because next Monday, we should be ready to go on that. The second major thing is we are expecting tornadoes at any given time here. So we have gotten the storm shelter open. Haven't vacuumed it yet. Going to have to do that right after this. But nonetheless, we've got a threat of tornadoes coming that I think potentially would impede on us being able to actually do a full show. Now, what I'll be doing in the show is that I will go through each one of the topics as quickly as I can right at the beginning. And the purpose of that is that some of you don't want to watch up to an hour show. Not really interested. Doesn't mean you're not interested in me, you just don't have the time. So what I want to do is pack in, here is the nuts and bolts of it in the first 5 minutes or so, and then spend the rest of the time not just fleshing these things out, but different from what you'll see in these videos that I had told you about. The show will walk you through examples on how I've come across this, some client stories, some real live applications to that I'm not going to put in the videos that are related to these topics. So what is the point of JJ the CPA's Small Business Toolbox? Well, the purpose of it is for us to have fun, for us to learn together, for me to get to know you, the community, beyond now the pandemic. And it is a way to kind of launch the week, meaning we'll come live to you every Monday at 4 p.m. Central Standard Time. And after that, each day, there will be a new video that comes out at noon Central Standard Time. And those videos are going to stem from this show in terms of the topics. But those videos will not just simply be a replica of the show segmented out. The show will be these same topics, but with commentary, story, some fun that goes along with it. We do anticipate long term, since I'm going to take the opportunity right now to just tell you about the show, to find ways to better interact with you, either live during the show or with topics that you can bring to us. So my email is jj@jjthecpa.com. And if you're listening live or listening later, feel free to email us a topic in the regarding line. Just put topic or something that would let us know that you're giving us a suggestion either for video or something to talk about, or ask a question and we may be able to answer that on the next live show. What we want to do also during the live is find a way to interact with you. Most likely that might be at the end, interacting with some questions. We may get super fancy. We haven't really determined this because obviously we'd be providing a phone number that the world would have, but we'd like to find a way to, in essence, get a caller that we could talk to while we are live. And it may be that you email us and we email you back and say, hey, what's your number? We'll call you live and go over your question and talk about it. So the show, in my opinion, is really a launch to the week. And as we go through week to week, the subjects that we're covering that are really focused in on the small business owner, the self-employed, and the advisors that work with these groups, we're going to expand on these issues over and over. Now, I'm going to tell you, because I already know several that are watching here live are a part of my Group 51. So thank you for being a part of this. It is a private group. So I'm teasing you with that because I'm going to reopen it, but not till the end of the year. And that's a private group that gets a seminar pretty much every week for an hour, going through details with PowerPoint slides and really deep diving in terms of what issues I'm going through with my clients. But this would be the next best thing for those of you that are not interested in being a part of the private group or paying the fee to be a part of it, which I think is reasonable for a full year. But at the end of the day, I still want to keep the spirit of JJ the CPA alive, which is providing good information to you on a regular basis, but the focus being on small business owners. I'm going to let you know this because we're going to be fleshing this out. We had a great tax season, finished it up. We had some rest. We went to Las Vegas for a short period of time, but we're now fleshing this out. So we plan to grow with this as well. But part of what I'm going to let you know is I know there's some CSR in particular, Rob, Tony D, I see that you're on. I can't quite see any comments, but point is that I know that they enjoy some of the videos where I'm driving in the car or I'm providing a story, for lack of a better word, that's not really a pinpoint hardcore, here's how you become an S Corp. So with those, what I plan to do is have a page on my website that would allow you to go to that, and I would put there on a routine basis those kind of videos, but they won't be public. They'll be unlisted, but you would have access to it for free, no catch, don't need your email, but it would be a page that you could go and check out these other kind of videos that, to be honest with you, get about 200 to 300 views. But I Don't care that they only get 200 to 300 views. But as I move forward, I'm wanting to do some different things with my channel, to be honest with you, related to the algorithm. So I want to be able to provide great information for you and to you. But this would be a way to do it, in essence, privately, the same that I do with Group 51. Now, we would be having some graphics here. I probably would have been able to interact with Amanda. I can see her. She is resting. And so with that being said, we would have had some graphics come up, some sound effects, maybe a quick little 3-second little video. She created a really cool intro video that's like 3 seconds with JJ's small business toolbox. So we really do want to take this to the next level. Right now, I'm in what we call the homework room in my house, and I've got lights all around me. And I'm surprised we don't hear any thunder and lightning. It happens quick here. I've got a little window I can look out and make sure there's no tornadoes coming. Of course, I'll be listening for any siren. So I'm going to give you a little taste about the small business toolbox, so you know that things are missing of what I just described to you. Also, we would be able to have Amanda looking at the comments and either commenting back or maybe writing something down that I'd be able to address near the end of the show. So unfortunately, we'll be absent some of that. But when I go back to these subject matters, when I'm talking with clients, going to the first thing I mentioned to you, which is overlooked tax deductions. The thing is that I tell clients, let's look at it inverted when we're looking for tax deductions. Because typically when I bring on a client, new client, which I'm not doing anymore, but nonetheless, I've been practicing for 30 years. I've already told you that. But in the 26 years I was bringing on clients, one of the first things with small business owners and self-employed that I would hear is, well, hey, what are the deductions that I should be looking for now? So the first thing I look at and tell them is, let's look at what you're already spending now, because if it's for business purpose, we get to write that off. It never makes sense to just come up with a way to spend money for business purposes, because the only savings you're going to receive is whatever your tax rate is. Now, what does that mean? Well, if I were to say to you, hey, if you want to save some taxes, spend $1,000 on a new computer, that $1,000 tax deduction did reduce down your business or self-employment income by $1,000, but the savings would be whatever the applicable tax rate is. So if you were in a tax rate of, let's say, 25%, then that's going to save you $250. Sounds like a winner, and it is, but I wouldn't want you to go spend $1,000 buying a computer if you already have 4 of them and you don't need one. So let me back it up though. What I first start with clients is, and this is how I know that these are the 2 most overlooked deductions that I told you earlier, the cell phone as well as the internet at home. And it's this, because when we're then talking through, well, what are you already spending? And we're going through the checklist and I say, all right, well, are you going to write off your cell phone? Oh gosh, I didn't know that I could. How do I do that? Simple. If you're self-employed, you don't have to have a separate bank account. So just be gathering those receipts, that amount, and deducting it as a cell phone expense on Schedule C. If you're a small business, whether a partnership or an S Corp or even a C Corp, you're going to need to have a separate bank account. So you would have the business pay that. How? Simple. A check. Have an automatic withdrawal coming from the business account, or have a credit card that you only use for business, and that credit card is used to pay your cell phone bill, and then the business pays that credit card. The key here is that you're tying it to be paid by the business for those that are partnerships, S Corps, and a C Corp. And then same thing with the internet. Well, wait a second, how do I do that? Well, if you're self-employed Schedule C, it's just gathering up that amount and deducting it as an internet line item expense separate from the home office on your Schedule C. Now, if you're a small business, as in an S Corp or a partnership or a C Corp, the way you would do that is, the simplest is you would fill out an expense report, just the same as if you were an employee for that business and you spent money personally and that business needed to reimburse you. Very simple expense report. What does that look like? I mean, it could be handwritten. It doesn't matter. It could be in Excel. It could be nice and fancy. In my office, It just says, here's the name of the business, expense report, the date of it, and then it's just some columns. What's the date of the expense? What is the expense? How much of the amount? Add it up, and then a business writes you a check. But what I want you to hear is, what's important is not just identifying the expense for your S Corp partnership or C Corp, but having that business pay for it. Now, directly is better. So at my office, I have internet and a phone. My business pays that directly. But for my home internet, I'm having the business reimburse me that amount. How often? Well, as often as you want, monthly, quarterly, annually. But know this, you only get to write it off in the year that you reimburse yourself, just the same as if you were doing that with an employee. Now, why an S Corp? I told you earlier, it really comes down to one thing, like why. Now, if you're talking with somebody else, they could come up with other reasons, and there are other reasons to become an S Corp. But if you're not going to save self-employment tax, that's kind of the first reason you wouldn't worry about being an S Corp. So if you're going to net, and this is what I tell clients, about 20 to 30,000 on your Schedule C, then it starts to make sense to be an S corporation. How do you become an S Corp? You file a Form 2553. Don't try it at home. I'll talk to you about it in this at-length video I'm going to release this week. But it's a Form 2553. It's not a big deal. Yes, there's rules and regulations and how do you fill it out, but that's why you need a professional. But when is it time? I told you why to become an S Corp. It's to save self-employment tax, 15.3% on whatever it is on your net Schedule C. And you're just laying there. You don't have any choice. What's my net times 15.3%? There's my self-employment tax, and that's on top of income taxes. By filing a Form 2553 timely, and then now being taxed as an S Corp, that net income from your business is not subject to self-employment tax. And the reasoning is that that gets reported on a Schedule E, page 2, and it is not subject and then reported on Schedule SE of the individual tax return. It is not subject to self-employment taxes. What's the catch? Yeah, there is one. The catch is that in an S Corp, you do need to pay yourself some kind of wage. Now, if you're netting 30 grand, maybe you could pay yourself a small wage and you'd still inch out some savings. And why does the wage matter? And why does that, in essence, become a rub with the S Corp? Well, the first thing about it is that payroll, when you pay yourself wages, just the same as if you were to pay yourself an employee. And again, this is not for the self-employed. Self-employed Schedule C filers cannot pay themselves wages per the IRS directly in the instructions for Schedule C. So I'm now talking about an S Corp owner paying themselves wages. A partner cannot pay themselves wages by law. A C Corp can pay the owner wages. So again, we're talking about S Corp here. But when you pay yourself wages just the same as when you pay an employee, it is subject to Social Security and Medicare taxes. It's 7.65% for those taxes withheld, and it's 7.65% for what the business has to match. Guess what? That combined, 7.65% withheld, 7.65% matched, that combined is 15.3%. Well, that sounds super familiar. Well, it is, because self-employment taxes are nothing more than the same category of tax. Self-employment taxes is Social Security and Medicare taxes. And the reason it's the full 15.3% is that self-employed can't pay themselves wages and they don't have an employer. They're not able to consider themselves an employee. But with the S Corp, you pay yourself wage, it's your business, whether it's withheld or matched, it's still 15.3%. So if you're following me on the simple example, I'd love to have a whiteboard. I see Clay's with us. I know he likes the whiteboard. But if we were doing our real show, we'd be able to pull something up. If you're just joining us, Amanda, my fiance, my producer, is recovering well, but we were in the ER, and so she's unable to participate and help with the show. But she's doing well. She's doing very well. But let's just back up, okay? So if I had my whiteboard up here, what I would tell you is, if you're netting $30,000 on a Schedule C, you're going to pay self-employment taxes of a little over $4,500. How? 30,000 times 15.3% is over 4,500 just in self-employment taxes. So now let's look over, and if you have an S corporation and it nets 30,000, okay, it's going to pay no self-employment tax on that 30,000 down at the individual level. But you do need to pay yourself some wages. Let's just say for grins, you paid yourself a wage of half, 15,000 of it as wage, and the other 15,000 as a distribution, which is just writing yourself a check, not payroll. Well, right now you would look at it and say, okay, well, if I only have a wage of 15,000, then my payroll taxes is only on 15,000, right? So we'd be looking a little over $2,250 in payroll tax. And so I could look at that and say, hey, listen, as an S Corp, okay, that 30,000, even with 15,000 in wages, that Social Security and Medicare tax is going to cost you $2,250. That same self-employment tax, which is just Social Security and Medicare, but on a Schedule C, you have no choice. It's on the full 30 grand, and that's 4,500 and some change. So the savings right there is $2,250 and some change. But here's the catch, is that the IRS doesn't have a way to dictate what they feel you need to pay yourself as a wage. And then that's where the rub comes with, well, how much do I pay myself? And the reason I tell you, and this is what I would say to my clients, that we might wait to 20 to 30,000 in net income on a Schedule C before we elect an S Corp, is this. When you do have an S Corporation, you're filing a separate tax return. No taxes due with it, but there's a cost associated with that. You're going to need to, for sure, 100% have a separate bank account. You are going to need to have payroll taxes, but also most likely you're going to need to hire a payroll service. And those things have cost to it. Not to mention, in the first year, there's a cost to set up the S Corp, potentially some attorney fees, but also with the Secretary of State. So what would I say on that? Well, let's just say for grins to do the business return, then you would be, I'm just pulling a rabbit out of the hat dollar amount. Let's just say it's $1,000 for somebody to do the S Corp return, right? And then you got to pay someone $50 a month to help you do the payroll. So that's $600 in a year. That's $1,600. And the first year set up, maybe a few $100s there. So you're going to have some cost to it every year. So when you're looking at it all encompassing, it's like, okay, in the example JJ just gave me, if I have a Schedule C versus an S Corp, he just told me I could save $2,250 with $30,000 of net on Schedule C. And with the S Corp, I would be paying myself a wage of 15 grand and then a distribution of 15 grand. When I compare the Social Security and Medicare tax, you're saving around $2,250. That sounds like a winner. You're right, it is. But there's going to be a cost associated. Now, most of my clients say, listen, if I'm at a break even, I want to become an S Corp. Some say, you know what, I don't really want to do any of that until I know I'm going to save more than what the cost is going to be. And that is why I say typically it's around 30,000. Now, one of the things that I do is travel around the country, got limited during the pandemic, but I travel around the country talking to fellow CPAs. One of the things I do now is I have my own CPE. You're probably aware of it, but you can go to jjthecpacpe.com or go to my website. There's a link to it. Here's the reason I'm bringing that up to you. Not only is it a plug, you're right, I wanted to plug that I'm doing CPE, but I, in essence, instruct fellow tax pros. Now, I'm not telling tax pro stuff typically they don't already know, but I'm updating them, talking through strategies. But my point in saying that is that when I traveled around the country, Amanda and I did, and we've gone to probably at this point over 75 different cities, obviously the pandemic not being a part of that. And one of the things that I typically would ask to the group of tax pros, CPAs, EAs is, hey, what is kind of your break even to tell somebody it's time to become an S corporation? And it's pretty much in line with what I'm thinking for the same reasons that I'm thinking, which is the costs not outweighing the benefits. We want the benefits to outweigh the costs. Now let's just ramp this up, and then I want to go to the next thing. If you're netting 100 grand on your Schedule C, you're paying over 15,000 in self-employment taxes. So if you were an S Corp and you're netting 100 grand and you paid yourself a wage of 50 grand, pretty reasonable, right? Well, the wages is the only thing in the S Corp scenario that is subject to Social Security and Medicare taxes. So you are going to have 7,500 and some change in those taxes, payroll taxes through the S Corp, but you're going to save 7,500 in essence because that other 50,000 that you're pulling out as a distribution is not subject to Social Security and Medicare taxes. So you would save 7,500. That sounds like a winner. The last thing I want to tell you, the biggest reason we don't typically start our new startup clients as an S Corp or even a partnership is what I'm getting ready to tell you in the next subject is we have our clients always set up as an LLC. Always, always, always set up as an LLC. Now, there could be in some states an LLP somehow has a benefit due to state or franchise state taxes over an LLC. But an LLC is your legal designation. So here's the typical situation with my clients. So I have a client, they've been a client for almost 25 years. And this client has grown their medical practice. It's a surgeon. Well, guess what? After 25 years, all the kids are out of the house. One of the kids is actually coming back to work with my client, his dad, which is pretty exciting. So working in that circumstances and getting the son involved. Worked with them for 25 years. I've seen their kids raised up and they've now got little ones. So it's like working with 3 generations. Pretty neat. But house emptied out. And so in talking with the spouse who was busy taking care of the family, and years earlier, though, anticipating that being an empty nester, started to really look at, well, what does she want to do entrepreneurially? So she has a background as an entrepreneur and a degree. How do I put that to work? And she narrowed it down to being a real estate broker, advisor, salesperson, professional, whatever the terminology is you want to pick, basically selling real estate. So when I first sat down with her and we were talking through, well, what kind of business are you looking at? The thing I told her is no matter what, whether you're going to be a real estate advisor, you're going to be a consultant, we want to set you up as an LLC. An LLC doesn't automatically require that you file a separate tax return, because if you set up an LLC and you don't have a bank account, there's nothing to file. If you set up an LLC and there's really no election that you make with the IRS, either Form 2553 or 8832, then you're just filing it all on the individual return. So you can't go wrong, at least the way I see it, with the attorneys I work with and here in the state of Oklahoma. And I just don't see how it's any different in any other state with all the other CPAs and EAs that I've interacted with around the country. But nonetheless, you need to consult your advisors on this. But nonetheless, and here's the deal, because the LLC, as I told you earlier, is a chameleon. It can be taxed as anything. So if it's taxed as anything, now we have every choice. It doesn't matter if it's real estate service or she wants to build a company that's going to buy and sell widgets. An LLC is the legal designation. But typically in the first year of my clients, we are probably not electing for them to be an S Corp or even a partnership. Now, I will tell you this, if they have a partner, they don't have a choice. They've got to file something separate. I'm talking about the person that's a one-owner business. And by the way, if you're a one-owner business, you can't be a partnership because you need 2 people. I digress. Why would I, in this circumstance with a one owner, say, okay, we got your LLC set up, but let's not elect for you to be an S Corp yet. Or we never would probably want to be a C Corp, never have found a situation in 30 years someone wants to be a C Corp. But the reason is this, if you're going to have losses in your initial years, You don't have a basis problem, a tax basis or at-risk basis problem when you have a Schedule C, that's the self-employed. So it can be a single member LLC filing a Schedule C. And if they're going to have a loss the first year, we don't have to worry about basis, because a downfall to an S Corp is that if you do have losses, you're only able to deduct the losses to the extent of your tax basis or your at-risk basis. What is that? Well, check out the video where I'm going to go more in depth on this. So when I'm sitting with this client, husband and wife, and the wife's now setting up the new business, it kind of takes away these hiccups that many small business owners seem to have to just get going on their business, right? It's like, well, what should I be? LLC, let's move on to the next thing. How should I be taxed? For right now, you don't have any income, you don't have any expenses, you haven't built the empire yet. Let's not elect to do anything other than let's now see, well, what are your expenses going to be? What is your income going to be? And here's why. And I saw it did pop up. I've only caught a couple things, but somebody said, is it too late to do this for 2022? And the answer is no, with caution. And the reason I say that is that you do have until March 15th of 2023 to decide if it makes sense for you to be an S Corp for 2022. How? Well, in the Form 2553 instructions, it tells you how to do that. It's technically a late election, but they're done every day. Most clients, all of them that we elect for it to be an S Corp, is not in the first 75 days of the year. It is always with the initial tax return or the year that we want it to be an S Corp, because we're trying to provide options for ourselves and for the client. So with that being said, why do we have to make the election minute one before you decide how you're going to build your empire? We're going to be a Schedule C, you got losses, we can write those off, we don't have any issues, and then you just become an S Corp. So you can set up an LLC right now in 22, get your separate bank account, continue to go. Well, what's your revenue, what's your expense? That's the main thing to track. It would be by March 15th, that's the due date of an S Corp return, that you would need to file an S Corp election. Now you can file an extension and file it later than that, but gosh, I can't get into too many weeds here. All I'm saying is it's not too late. It's not too late. The other aspect of this that I want you to know is that you can't become an S Corp, though, any earlier from the date that you set up your LLC or your entity. See what I'm saying? You can't sit around and say, well, I don't want to spend the $100 to become an LLC until okay, that's fine. But, maybe no harm, no foul per se. But why don't you just set up the LLC up front to my client? Because that's a no harm, no foul. Because if you're not serious about running your business, that's evident the fact that you don't want to spend $100 at the Secretary of State getting your LLC and going online to get your EIN. And maybe you pay an attorney or go to LegalZoom, help you put together your operating agreement. But here's the deal. Most clients in the past, they use that as the excuse to not jump off the cliff and start working evenings on their new business or weekends on their new business, because they hide behind, well, I don't know how I should be taxed. I don't know if I should be an LLC. And I spent all this time watching videos and listening and all that. And so I'm so overwhelmed by that. I can't yet start my business. And what I tell clients is this: you haven't started a business until you have gained a customer, and really not until that customer has paid you. Now you have a business. That should be the number one focus. So I try and simplify this down for my clients when they're setting this up and getting into business. Now, what if you've been a Schedule C for years and you don't have an EIN? You've never set up an LLC. Guess what? Great news. You set up the LLC, boom. You now have the ability to be an S Corp starting the day that you set up that LLC. Go get you a tax ID number. It doesn't matter that you've been filing Schedule C forever. You're now formalizing your business by going to the Secretary of State and setting up a living, breathing, separate entity, right? And then at the IRS level, you're determining how is this separate entity going to be taxed. So I'll be talking a lot about S Corps and scenarios. We'll be talking about partnerships and what is this at-risk basis and losses, because typically when somebody's starting a business, they have a loss the first year. Why? Well, because they've prepaid rent, or they've had to get a lot of supplies, or just get the utilities started, and it required upfront costs, right? First year, it's pretty easy for there to be a lot of extra costs, not to mention your startup costs. So it's easy for there to be a loss, especially most businesses don't start generating revenue the first day of the year. It's usually partial year, and it takes a while for it to ramp up. So you're giving yourself plenty of examples there. Now, one of the things I'm going to talk about next week, and I have an old video on this, and I may have taken it down, but I have an old video of this that Amanda and I were in New York City, and I was in Central Park, and I shot this video, and it probably was back, it was years ago, a couple of years ago. But the other thing I'm going to talk about next week on Small Business Toolbox with JJ the CPA is why you should not get tripped up on naming your business until you're either lock solid, ready to rock, and you're now worried about your name. Well, what do you do to get over that? Or, well, I don't even know how to get lock, stock, barreled, ready to rock until I come up with a name. And the name is irrelevant to your business. You don't have an empire yet. You haven't done anything yet, all due respect. What I tell people is your LLC can be anything, right? Jimmy 799 LLC. What's Jimmy 799 LLC? It's the name of an entity. It's a legal entity. Now you got your LLC started. What can I do? Set up the bank account, get my EN, start payroll if I need to, get loans, get them in the business name, so to speak. The LLC isn't necessarily what you hang on the sign out front. What you hang on the sign out front is, what is that business doing business as? It can be a DBA. Now, would it be better to come up with the name and then that's the name and you've reserved it? Yes, but in the state of Oklahoma, like any other state, right? I have my business and then I have DBAs. I own JJ the CPA, the CPA firm. Those are DBAs. They cost $20 that are in essence owned by my entity. So Jimmy 799 LLC, you probably never put that on the storefront or up on the website, right? But as you get going, typically you go, oh, this is probably my business name. Same story related to that. I'll let you know next week, where Amanda and I were having cigars. I was having a cigar in New York City the same day that I shot that video, and we shared it with somebody, and they said that they have been waiting for a year to start their sports agency because they couldn't pinpoint the name, and they felt the name was so important. And I told him what I told him that was in the video, and immediately he followed up with me. He got his business started next week, the following week. So I'll share that with you as well. Now, when we're talking about the difference between the IRA, the Roth IRA, the 401k, the simple plan, and the SEP, here's the first thing I want you to hear. Saving for retirement is saving, okay? Saving for retirement is putting money in the mason jar. It's putting money in the mattress, okay? It's putting money in a savings account. It's putting money into the stocks that aren't necessarily other than you're saving for retirement. So the first thing to determine is, how much do I need to save? And guess what? You'll most likely never be able to save enough. So it's not an excuse of, well, is this app real? Or do I have a financial advisor? Are they just conning me on how much I really need to save? Here's the thing. Most people, when you look at, well, here's what I want to retire on. Here's what I have. Simple math. Yes, you could take into account inflation, but here's what it comes down to. You're most likely not going to have enough every month to put away what you have to. Now, am I saying that you shouldn't do these plans and get with these professionals? No, of course not. What I'm saying is, especially to the self-employed and that small business owner that's just like my clients, okay? We find reasons not to save for retirement. Well, I don't know if I should have 401k or simple. What does that have to do with setting money aside for retirement? A simple or a 401k or the IRA or the SEP, all that has to do with is, well, how much can you put in this qualified plan and how much of a deduction can you get? Because each one of those have a max. So you can just like, well, I mean, I've talked with clients. In fact, I'm having breakfast with one of the clients that I'm going to give you an example of on Friday. And finally, what I told them, now this was probably back about 10 years ago, and they kept like, well, I just don't know if I should get in the market. I don't know if I should do this 401k, or should I do a simple? Should I be with this advisor? Should I be with that advisor? I said, Doc, how much, this is a dentist, kind of a rural city outside of Oklahoma. So good folk, working hard in the practice, pays everybody well, taking care of their family, lots of kids. But I said, Doc, how much are you even thinking you're going to set aside? Like, let's just start there. It's like, $500 a month. I said, guess what? None of this matters. All these things that you're asking about. Why does it matter what advisor you have for $6,000, $500 a month when you just need to get it going? Once you have $6,000, maybe an advisor wants to talk to you. What does it matter if it's a IRA or a simple or a SEP? You're not even maxing any of those. You're right, 10 years ago, the IRA was a little less. But at $6,000, you're not maxing a 401k or a simple plan or a SEP. So what are we talking about here? Not to mention, you're just not setting anything aside. So to small business owners and the self-employed, just the way that I've now counseled this client, and it's for me too, is you just got to be setting money aside. So when we talk about these different types of vehicles, think of it like this. Now, I'm going to admit to you, I was getting a pedicure. Okay. I think it was the day after the deadline. So April 19th, Amanda and I go get some pedicures. No, I don't get polish. Okay. All they're doing is cleaning my feet and, scrubbing them. And, they don't do anything really to my nails other than clean the cuticles and clip them. And I don't understand why that's a big deal. It's just cleanliness. My point is this wonderful nail salon has been clients of mine for a long, long time. One of my kind of originals. And I'm sitting there getting a pedicure, and one of the owners comes over and they say, I'm so sorry to bother you. I know you just finished up our stuff, but I have a quick question for you. I'm getting ready to invest in gold, and I'm reading something that says this is IRA qualified. So what is an IRA? And so I described what I'm getting ready to describe to you. I said, listen, an IRA, a Roth IRA, a simple, a SEP, a 401k, they're just doorways that your money goes through. Money goes through the doorway. Now it can be invested in anything. You just sit there in cash. You can sit there in a mutual fund, bonds, stock, right? There's ways you can invest in a real estate investment trust. It's about getting your money through the doorway, and there's only so much money you get to go through the doorway. So I said investing in gold can be definitely inside a IRA or 401k, et cetera, right? As long as in essence, paperwork is set up right by whatever entity you're working with, that it is a qualified plan. It is a simple, it is a SEP, it is an IRA or Roth or a 401k. Money goes in. See, my point here is this. Money goes in, you get the deduction. In retirement, you pull it out, and it's going to be taxable to you, all of it, including the earnings. But for self-employed and the small business owner, more what I implore is, let's be setting money aside. So I started my own practice when I was 25 years old, right? That's when I knew everything, and everybody I was bringing in, right? They were all going to be monster clients, and no one's going to ever go out of business. And so what do you do when you first start your business, right? You're just, it's like Flintstones time, right? You're simply putting out fires all the time, and it's a ton of fun. And what are you doing then with extra money? Probably trying to put food on the table. Make sure your bills are getting paid. But then when you start seeing there's extra money and there's more money, what does a small business owner and a self-employed usually do? Keep the money in the business to grow it, well, now that I have the extra money, I can get bigger office space. And so that's going to cost more, so I got to leave more money in there. Now I need another employee. Oh, now I need to, and you just name it. And that's all good stuff. It all makes a lot of sense. But you still have to look at the purpose in you having the business. Yes, it's to grow it. Yes, it's for the future. But you still need to be setting money aside, pulling money out, pulling profit out, even just a little, and setting it aside for retirement. Now, here's one that's going to blow you away. So I'm having breakfast tomorrow with my great friend, Jerry. And literally the day I started my practice, May 15th of 1997, I had lunch with Jerry and Jason. Jerry is a financial advisor and Jason is a banker. And they still are to this day. But one of the things that Jerry told me early on, and Jerry at that time was probably 26, so he knew everything too. But one of the things that he told me was he counsels small business owners to not re-risk their money, but to save the money that their business is making. What does that mean? Business owners take lots of risks, self-employed taking lots of risk. First of all, not a regular amount of income potentially coming in. You have variable costs. You have costs that you're committing to. There is risk. You're borrowing money to pay for these. There is risk, right? A lot of risk. So when you're looking at a portfolio, right? Where is my money? Where is my assets for me as a self-employed, as a small business owner, right? If the entire pie is this business, that probably doesn't make a lot of sense if you were looking at that person's portfolio, right? There probably makes sense to have a little real estate in there, right? Even if it's your house, should be some savings in there. But this is a financial advisor with a Series 7 as well as the other licenses that makes a living in putting clients' money in the market, okay? In the market. And I have money in the market. But when a financial advisor puts money into the market, it's typically in large cap, small cap, maybe a little bit of foreign, might be, indexed, spot, a lot of different things. Why? Because they're diversifying your money, right? So when you're looking at your pie, you don't need to take as big risks on the money that you're saving for retirement. Doesn't say you shouldn't. You want to take risks with your money, go ahead. But here's what I always hear from small business owners and the self-employed. I can make more money in my business than if I handed it over to somebody else, right? So I've got a client, Peter, it's his answer to everything. Why would I do that? I'm going to make more money doing this flip in this house. I'm going to buy it. I'm going to fix it up. I'm going to sell it. I'm going to make more money doing that. Peter, how much money do you have set aside for retirement though? Right? How much money is just set aside from doing all this? Right? You are doing a lot of risk with your business, expanding it, whether you're somebody that's in real estate or you're starting, name all the different kinds of businesses. You're taking a tremendous amount of risk. Awesome. And you should be commended for it. And all the success hopefully comes your way. But what you want to look at is, of the money you're pulling out of the business, and you are now handing it over to somebody, right? A good advisor. Do you need to really re-risk that? Because a lot of small business owners, they're doing this, right? They're like an entrepreneur, like, oh, I can make money doing that. Oh, I might make money doing that. Well, I better put money in this fund, or it's going to double here and it's going to double there. But anytime you're putting money in something that does have more potential of growth, right? Small cap stock might be one of those. I have money in small cap stock, okay? This is not to tell you to not put money in the market. It's to tell you to be diversified. But if you're looking at small cap, right, type investments in the stock market, you could look at it and go, wow, historically they're 20% one year, 30% next year. But then you got to look at, but how far do they dip? And here's what's crazy. You look at historically the market, 5 years, 6 years, maybe it's been down the last 30, right? That's it. So you think, well, I should put more money into that because it's all going to grow. But you also have to look at, but when do you need to pull the money out? How do you know that the market's going to be up when you need the money in retirement? Do you need to re-risk it? Yeah. Okay. But not the same way you're already risking everything with your own business. So when you're talking about retirement, what I'm bringing it back to is, I tell clients, I don't care if it's a 401k yet, if you're not setting any money aside. You need to set some money aside. Why do you do a 401k or an IRA or a SEP or a simple? Why would you do that? So that I can get the deduction, right? Well, if you know you're going to get the deduction, and then you just have to, well, what's the maximum that I can put in? Decision's over, right? And there's nothing to then trip up on, right? Especially if you're just a one owner, one employee. You got a few employees, and you look at the different aspects, and I'll have a video that talks more about this. The separate bank account, right? So when I first started my practice, right? Now, there was no LLCs. I'm definitely aging myself. There were no existing LLCs in the state of Oklahoma in 1997. This thing didn't come around until after the turn of the century. So I'm a PC, a professional corporation, okay? Elected it to be S Corp, right? But here's the thing, I immediately got a separate bank account, even before I knew what my structure was going to be, right? In terms of with the IRS. So getting your legal designation is really step one, because then you're getting your tax ID number, and then you're getting the bank account in that LLC name, in that EIN, and you're off and running. And that's really when you've breathed life into the new business. Now, this is getting ahead of myself. We'll probably be talking about this in future episodes. But you really can look at setting up LLCs and putting them on the shelf. I saw a name pop up. I'm definitely not going to identify them because I'd be giving something away, but I saw a name pop up that was in my 12-week group, one of my original groups. Hope you're doing well, my friend. Phenomenal family, like unbelievable, the entrepreneurship in this family. But one of the things that we talked about, we did some one-on-one, was setting up LLCs and putting them on the shelf. What does that mean? Setting up an LLC, getting an ID number, setting up a bank account, putting some money in it because you just breathed life into a business. And now you come across an opportunity, you come across a separate situation or business, you already have that up and running. And why also was that matter? You got the clock ticking on that entity that if you actually ultimately sell the entity, you're helping with either long-term capital gains, even though that's a year. So with that being said, I'm getting ahead of myself. No more delays, in my opinion, on should I set up an entity, even if I'm just starting it out. Now, if you want to wait a little bit, you can. But to me, if you have a plan B, that means you don't have true, in essence, buy-in in your plan A. So when you're starting a business, go with plan A. And it starts with getting that LLC. You can figure out plenty of time how you want it to be taxed. It just needs to be by March 15th of the following year, especially if it's going to be an S Corp. Now, lastly, and in our closing, is this. So the word life insurance. I'd be curious to see if now people exit. Here's something else you probably don't know, but I am a licensed insurance professional. I did that to protect my clients, so I really would understand the industry. But when you look at life insurance, yes, there's whole life and there's term life. But the biggest question you come across is, well, how much do I need though? Right? It's not an emotional decision. Now, a salesperson, a good one, I can tell you one right now that I'm getting ready to go head to head with and knock them straight out from what I believe they sold my client, unbeknownst to me, that I don't think is a match and is really, well, I digress. Not happy about it. Here's my point. A salesperson, okay, is doing their job by ensuring you buy life insurance. But one of the reasons I had success is I don't sell life insurance. I have clients that buy life insurance from me, but I don't sell it. Why? Because it's a 1-minute calculation, if that. There's zero emotion in it. How much life insurance do I need? Well, the first thing is you don't need any, because if you die, you're gone. That money doesn't help you. So the real question is, but okay, then how much does my family need? Okay, and it's simple. What are you living on a month times 200? You need that. How? Why? Because whatever they're living on a month times 200 equals the amount of life insurance that you would have, that then on an average, it would earning 6% a year, would yield forever without touching principal, that $5,000 a month. Just do the math. 5,000 times 200 is $1 million. $1 million times 6% is 60,000. 60,000 divided by 12 monthly is 5,000 a month. Pretty simple. So when you say, I don't know how much life insurance I need, there's your calculation. And I just tell clients, we take that and then we just add to it what debt do you have personally? And then for the business owner, how much debt do you have in the business? That's how much life insurance you need. Now, when I'm talking with young folks, we talk about, well, what kind of debt do you think you're going to have soon? Like, you're going to have a 100,000 mortgage, 250,000. You might want to think through that. But the thing I want you to really take away from the life insurance is that if you feel as though someone's selling it to you, and how do they sell it to you? They may say things like, and it's to help you, but they may say things like, what would life look like if Brian passed away last night, Tracy? So Tracy, I want you to imagine right now that you've woken up today and Brian passed away last night. Now you're being sold. But why are you being sold? Because someone didn't give you the simple calculation. How much do you need? Because why would you buy more than that, right? But at the same time, there's never been a widow or widower that has said, yeah, that left me way too much life insurance, right? So how much do you need? Then that's how much you should go and buy. And then it comes into, well, can I afford it? Do I want to lock that in for 10 years or 20 years? Do I want it to be whole life? And I'll leave you with this. You do a mixture of it. My clients that do it, they have some that's at 10 years, some that's at 20, and a little bit that's at whole life, right? And as soon as you're like, oh, this is all scam and all this stuff, that's when you've told yourself you're not going to pass away, or at least you're not going to pass away before the age of 65. And now you're a great bet. If you know for sure nothing's going to happen to you. Now it sounds like I'm selling you. Guess what? I can't sell to you. Can't. So that's why you can hear a voice from me on why you just need to take a deep breath. For those that, I don't know if I have enough, or am I being sold? How much do I need? There's the calculation. All right, I'm 1 minute and 45 seconds over the hour. This was a great first run. For those that have joined late, JJ the CPA Small Business Toolbox, this is not what the show is going to look like, even though I've had a lot of fun. Amanda, if you also came late, is doing well, still resting. Okay, still resting. But she's doing okay. There was a little scare last night, and we went to the ER, and we were there for a while. They were awesome. They were wonderful. The folks at Mercy Health in Oklahoma City, phenomenal. Nurses, phenomenal. PA, and just phenomenal, everybody. So with that being said, when we see you next Monday for JJ the CPA's Small Business Toolbox, 4 p.m. Central Standard Time, going live, we'll have the actual background. It'll be pretty reminiscent to what we used to have. And we hope that you'll be a little more entertained, even though I don't feel like I'm here to entertain you, but a little bit more interactive, a little bit, and some graphics and some little videos that might pop up. And as I'm saying some things, some words that can pop up. Now I'm going to tell you this, in the bottom of the video right now, you're not going to find any links. So within about an hour after the live, which should be around 6 p.m. Central Standard Time on Mondays, any links that I tell you about, I didn't give you any links today, but any links that I tell you about, they'll be in the body of the video. The other thing I'm going to do is that when I put together the videos that stem from this, I'm going to give you links to them. Now, guess what? Normally, you would find those links after the close of the live show to go and watch these other videos even before they're public. Meaning I give you the link, you can go watch it even before I release it to the public as a thanks for watching the live, okay? They'll be released the rest of the week, but you can watch them now. So my goal is that I would have those videos shot. We weren't able to do that today, so that when I come to you and we're live, you can, on any of the subjects that you're interested in after the live is over, go right then and go into my deep dive. I'm going to try and keep those videos to about 5 minutes or so. And that means that I'll have more videos related to these things. I saw a few brief comments. Thanks for being here and being a part of this channel and this community. I appreciate all the support. And I hope that today has been at least informative and of value. It seems as though it has. Appreciate the thumbs up. We've got 33. We've held almost 50 people the entire time, which is great. Mike, great to see you, my friend. Thank you so much. I appreciate you. and all our best to you. CSR saw comment, and Rob and Robert of Philadelphia Salons. And Want a Cupcake, how are you? Part of our Group 51. And so if I didn't see your name, it just only pops up for like 3 seconds. I apologize, but thank you, CSR. You know, I'll tell you this, CSR made a comment once, and I believe it was in January of 21. And we hadn't done a live in a while. And I think of this comment that CSR left, at least weekly, which was, he hoped that the community or the spirit of the channel wasn't going away. And a part of that was the lives. So with that being said, we're looking forward to the lives. We're looking forward to now really kind of building a community that's not based on us hovering around the campfire as the world is falling apart around us, or we're trying to find ways to survive. Now it's during an era as we move forward where it's time to thrive, right? Time to get to the next level, open the next business, or whatever it is that you're going to do. And so I look forward to being a part of this journey with you, so to speak. And if this is a success, maybe we'll go live more often. But for now, I want to really pack the punch. Richard, CPA, how are you? I really want to pack a punch into a show once a week. CSR, keep holding that Teldar paper. Wall Street. Peter, thank you. I appreciate you. All right, with that being said, I'm going to sign off. Thank you so much for being here today. Thanks for being a part of this. For those that are tuning in later, thanks for getting all the way to here. Hopefully things will grow in terms of the knowledge that you're going to gain from not just this show, but the videos in this channel. And I look forward to putting this community together in essence as we move forward. All right. Now, all of you that are probably here by now, I love it. Thank you, CSR and Rob and Glenda. Glenda, late to the party. Great to see you, Glenda. You know that I end every video by saying this, but I'm going to also start adding this. All right, hey, thanks for tuning in. I'd love it if you subscribe, but then I want you to never forget you've never met a small business owner or a self-employed individual or an advisor or anybody quite like you. And you've never met a CPA quite like me. Y'all have a great one. We'll talk with you. CSR, I finally got his subscribership. All right, much love to everybody. Thank you so much for all the support, and I look forward to seeing you all soon. And thank you, Stacy. Good to see you. And be looking for the videos to come. All right, I will pass on everybody's well wishes to Amanda. She's already doing great. She's just in her recovery period. Greg, how are you? Good to see you from the beginning. And Jess, thank you so much. Appreciate you. And with that, y'all have a great one. And I'll talk with you soon.